So, hello and good afternoon. Welcome everyone to today's weekly market outlook here together with Admiral Markets. My name is Jens Klatt and I'll be the moderator here for the upcoming, something like 40 minutes, I think, 45 minutes. We have, in fact, plenty of things to cover. There has been fantastic start into the day, to be honest, into the weekly close with the gold price shooting to new yearly highs. And we are probably about to see the beginning of something really big for the, I'm not sure, 12, 18 months or something. So could be that together with next week's Fed rate decision on Wednesday, one second. And then from a technical perspective, I'm breaking above 1,360, 365. Together we have technically and fundamentally a strong buy signal for gold, and which could, as I already said, in the upcoming 12 to 18 months probably bring us as high as 1,700 USD per ounce. So this is definitely something very, very interesting to look at. But before we have a look at this, as usual, we want to go through the risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure to read the terms and conditions of the service from Admiral Markets. The full risk disclaimer can be found on the website here at admiralmarkets.com. Nevertheless, we want to dig a little deeper here into a decision which took effect from, one second, which went into effect here last year in August. It was the ESMA decision, a differentiation now between retail clients and professional clients. And let's have a look here of why is that of interest. So there's now a leverage restriction for retail clients with a max of 1 to 30 when it comes to Forex majors. So this is Euro USD, for example, dollar JPY, and also a leverage cap of 1 to 20 here on so-called minor currency pairs, GBP Australian dollar, for example, but also on CFDs like DAX 30 or also gold, for example. And this is only true for retail clients. Clients who are classified as professional clients are not affected by this leverage restriction. And there's something else noteworthy here in this case. There's also now a negative balance protection, an unlimited negative balance protection when you're classified as a retail client, while you do not necessarily have this when classified as a professional client. And there, something special when it comes to Admiral Markets comes into play. As a professional client here at Admiral, you are also protected up to £50,000 sterling according to the policy from Admiral Markets. Further information, feel free to reach out to Admiral directly, but also reach out to the website, to the customer support, whatever you like. So this is me. This is the face to the voice you're currently listening to. And it's probably not the only thing, but the only thing we want to focus on here, which is interesting when it comes to my person, is I'm also located in Germany, in Berlin, Germany. Admiral Markets has an office here, also not only in Germany but also in Berlin. And so when we talk as traders among colleagues, for example, about brokers and their competitiveness, especially when it comes to DAX trading, since the DAX is the most traded asset here in Germany when it comes to CFDs, then we usually refer to Admiral Markets as the so-called DAX expert with a typical spread of 0.8 during the main trading hours. But also there's another offering now which is of interest, especially for short-term traders, scalpers probably. There's another offering of 0.2 during the main trading hours with typical spread of 0.2 and commission on top of that. This is true for the so-called Admiral Prime offering. In both cases also, the FX offering is very, very competitive. For further details, I highly recommend reaching out to the website and check out the offering from Admiral yourself. I've already said the office in Berlin is one thing. If you're located in Germany and then one rather sooner or later you live here in Berlin, or rather sooner than later plan to come here, I don't know, for vacation, you can feel free to check out the office location there here in Germany. But this is also true for other countries around the globe. There's also an office in the UK. And Admiral is also authorized and regulated by the FCA, but this is also true in Cyprus, for example, by the CISEC. Probably this is especially interesting for those thinking about the Brexit in this context. Not dig into too many details, but also very interesting for Australian traders, Chilean traders from Chile. I'm not sure. And also Admiral is regulated and respectively registered there, and then also has an office there. So feel free to reach out also in person to Admiral. Here are the contact details. And then we want to dig into our agenda and have a look at what we want to look at. I already mentioned it at the beginning. We definitely have to have a look at what to expect from the Fed next week. And I think it's so far getting more and more interesting, especially after inflation data last Wednesday, when inflation came in below expectation, which is not such a big surprise in my opinion, due to the developments in energy prices and the drop over the last weeks in WTI, for example. And so it's not such a surprising push here, but nevertheless potentially another trigger which is used as a fundament then from the Fed to cut rates already next Wednesday. Even though probability so far sees only 2 out of 3 market participants seeing the Fed not moving at all and moving with a more than 50% probability based on the Fed Watch tool in July. Then this is definitely the main focus we want to put on. Then sure, we want to look at the current bias in the FX, equity, and commodity markets. So especially probably also around the geopolitical tensions now between the US and Iran. There's also something which is probably one of the drivers lower for equities today. So when looking, for example, at the DAX, you can also spot some dynamic on the downside. Question here is, even though the overall picture still looks neutral, in my opinion, but still there's a solid chance to get to see a test of 12,000 points already today. And by the way, the upcoming week is also very fascinating. Usually you expect the Fed to come out equity friendly, which is usually capable of pushing equities higher. That's not true only for the DAX, but also S&P, Dow Jones, NASDAQ. But, and this is the thing, the next 5 days, so next Monday till Friday, respectively Monday, Tuesday on the 24th, 25th, has been seasonal perspective-wise bearish window in which the DAX usually has lost some ground. Same is true also for US equities. So this is something where the question is, who will be stronger? Will it be the Fed or will it be the seasonal window? Yeah, sure. The next thing then logically is the question we want to try to answer here: which trading opportunities may arise? And now let's switch over to the charts here, and let's have a look here at in fact 2 trades. So this is my second webinar today for Admiral. In the morning, I had the pleasure to have hold a German webinar here already, and there were 2 setups. I made a topic. One in the DAX was a short trade. And this is so far playing out quite well with some standard setup. From time to time, you also find this, by the way, in the traders block section. Let me just switch over to the website then probably, and let's do the following. So admiralmarkets.com, and there you have here the possibility to click on analytics and then on traders block. And the great thing right now is that I know that on Wednesday we published an article which made exactly this strategy a topic here. It was another day, but nevertheless the same setup. It's always the same then. And applying the open range breakout strategy to the DAX, you can see it here. Probably I can also put the link into the chat box here. Let me just see. So I put the link here, and there you can see the rules I followed hereby in this strategy. We have only 3 steps. We define the open range, we identify the advantage based on the EMA 50. This is the blue line here in this case, and then we trade the break in direction of the identified advantage. And place the stop accordingly. And this is exactly what we did here. So we had these 2 horizontal red lines. These were the high and low. This is the open range. We entered the trade on the short side. Why? Well, obviously we are trading here below this blue exponential moving average, and then your short entry, you enter the market short here with a stop at this level, and we work with a risk reward of 1 to 2 in this case. So the initial risk is 55 points. So our take profit is then placed 110 points lower than the entry price, 2 times 55, and yeah, there you have the setup. And so far it's playing out nicely, let's say. What we have already seen is that we earned 1 risk, and this another thing which is of interest right here. The market had, after this break, already retested this region and made lower lows. So from a price action perspective, it's even though it's also fine from profitability and expected value perspective to keep the trades as it is here. Nevertheless, I think it's fine to move the stop here to this last relative high. So here in this case, and beautiful. So somehow it doesn't work. Let me just double check here the options. Probably this is the reason why it doesn't work. There we go. Allow automated trading. It should be allowed here in this case. So then it should work. Let me just see. Still doesn't work. Okay, we don't have time for this. I'll double check it once we finish the webinar. But what I can already say is we can move the stop here to 108. So this is the last relative high. There we go. So you can see there's the stop now, and yeah, obviously there's no risk connected to this trade anymore. So let's just see whether this plays out or not. Let's probably look at it here also from a dominating time frame perspective. The hourly chart, you can see this is a very, very, very crucial region. In fact, from a technical perspective, all in all, the picture is neutral. For the day, today here, you can see the market hasn't really seen strong dynamic on the upside over the last days. On the other hand, it has also not seen dynamic moves on the downside. It's presenting itself neutral since the beginning of the week, since the start. And nevertheless, if we break below this crucial support region here, you can clearly spot that there's in fact no support region to be seen till 11,900 points. That's then you can see it here. The reason why I mentioned not only an attack but potential drop below 12,000 points here, in fact, and it would obviously mean a nice profit for the trade then, that the setup playing out really well. Yeah, and this is exactly why currently the price action is of high interest, and in combination with those geopolitical tensions which are rising right now between the US and Iran here, probably there will be another push lower with US markets opening then. This is the case in 2 hours. So let's see if US equities come in stable or see a drop here too. And on top of that, there's also something worth mentioning. In already 1 hour from now, we have the retail sales data, which is, yeah, probably another driver higher for gold. We'll look at this in a few minutes, but probably, especially if the numbers come in below expectation. But if they come in below expectation, what we've seen over the last days was also something I mentioned several times already. Usually you say every bad data is now potentially good data. for the market, because any bad data set means a higher probability of the in this case U.S. central bank, the Fed, cutting rates or bringing up another round of QE or easing in general, in which direction ever. And so yeah, the thing here is that this probably was true over the last 10 years, sure, because there was no real further room on the downside after the big crash which happened in 2008 with Lehman Brothers going down and all this, and the global economy collapsing. But the thing now is that the easing cycle, which could be brought up from the Fed, means that we are really facing trouble and the risk of drifting into a recession here. And if based on that, the overall outlook for companies doesn't look that great. It definitely needs significant amounts of money, respectively more easing liquidity to pump up equities. And this is something I'm not really sure about. I don't really see, even though it makes sense, it seems to make sense from a yield perspective, especially, to say, well, if there's more liquidity, equities should go up. But nevertheless, I'm not really convinced by that till I really see it, that the market is reacting to bad news in a positive way. So equities are pumped up. And this is something which is also probably a driver lower than retail sales data than today at 1:30 London in this case. So yeah, that's it for the DAX in this case. And we can also finalize here already the picture then probably, and then look at the daily chart. So what you can clearly spot here is that we definitely see a sequence of falling highs here, even though falling lows, the picture definitely darkens only if we drop below 11,600 points. That would also mean that we're dropping below this blue line, which is the simple moving average 200 in this case, and would definitely darken the picture, activating 11,250 points. The thing is, we have, again, from a seasonal perspective, a good chance to get to see this and in the next week. Nevertheless, and there now the Fed comes into play. There's also yeah, we can call it a seasonality or a statistic, which says that it doesn't matter if the Fed cuts or if the Fed hikes rates. Usually, it's considered equity friendly, and there's something really interesting showing then that equities are gaining usually ahead of the Fed, and then everything what comes after doesn't really affect the markets in a very direct way. And for further details, we won't dig too deep into this because next week there will be, on Wednesday also, in the Traders Block section, an article on how to trade equities around the Fed, and give a further and detailed look on why usually the Fed rate decision, especially the days before the Fed, affect equities in a positive way. But this is definitely something worth remembering, and also something which I'm aware of, where I think, I'm not really sure even if we get to see the push lower today, and if we probably drop and close the week below 12,000 points in the DAX, if this is really then the real deal, or it's probably only a push which is not sustainable, and then we are bought back into the first days till Wednesday, Monday, Tuesday, on the next week. So from this perspective, I consider the picture currently neutral. Nevertheless, all in all, especially short term, if we dip below 12,000 points with a bearish touch, but then the deck cards are completely reshuffled next week on Wednesday, depending on what the Fed delivers. And now let's dig into the details around the Fed, and especially use here the gold chart. Oh, this is beautiful. This is still. Let me just first of all let's go here to the daily chart, and then we switch back to the weekly. Why did I do that? You will be aware of that in a few minutes. But you can already see it here. Gold broke to new yearly highs in the morning. We already made this, by the way, a topic and a technical piece on Monday, where we said after we failed to sustainably break to new yearly highs after the week NFP reading last week on Friday, we said now probably we first of all get to see a bounce back potential trigger can be found around 1,325, a little lower than that, 1,310 USD. And we, in fact, only pushed slightly below 1,325, and then we took on momentum from there again, and today broke to new yearly highs, which is also a sign of potentially risk off hitting the market. So let's say it's a combination. So the performance of gold over the last days, especially probably weeks, has been has been something which could be easily explained by yields. Today, here the push higher is definitely something driven by yields, lower yields, especially short-term yields. Therefore, let me just show you one chart which I prepared already here on my Twitter feed. I retweeted it, so it's not my chart, but it's a chart from somewhere else. Here, this is very interesting from an asset manager. Here you can see gold versus short-term treasury yields, and you see in blue gold, and you see in black 2-year T-notes here. It's inverse, in fact, but nevertheless you can clearly spot that usually lower short-term yields usually represent a lower GDP growth, and this is definitely something which can be seen. All the skepticism rising right now around the overall economic outlook for the US, and so push higher in 2-year yields is then going hand in hand with a push higher in gold. And to be honest, I somehow think that we are not even close to have found the top, respectively bottom, no, the bottom. We are not even close to have found the bottom in yield. So this is inverse. So yields are dropping. So that's why finding the bottom, not seeing the top. What do I mean by that? Well, therefore, let's look at the Fed in the upcoming week. What do we have here? It's the Fed Watch tool. I can share, by the way, also here the link in the chat box. The Fed Watch tool gives you an idea of what market participants are expecting in regards to yields from the Fed in which direction the decision from the Fed will go. So why is that of interest? You can see here, this is the current target rate. It's 225 to 250 basis points. And obviously, only 1/3 of market participants, which is represented here in this graphic, is seeing a rate cut from the Fed next week. This completely and dramatically changes when going as far as December here. That you can see that not even 1% is seeing this target rate here at the end of the year, but in fact, most of the market participants are expecting the cut. It's more than 50% of market participants. It's 38.8 plus 21.9 plus 4. So if you add up those numbers, you come in at around 2/3 of market participants right now here in the Fed Watch tool see the Fed cutting rates 3 times till December. So, based on that, the thing is that one would probably say, okay, well, then this obviously explains this aggressive push higher here in yields. Yes, this is true, but the thing is that there's only 2 events in September and in December, as far as I know, where Fed Chairman Powell is sitting in front of journalists and giving an economic outlook, economic projections and all this. I really have trouble to see the Fed cutting rates without having the Fed chairman sitting in front of journalists answering questions around this. Probably I'm mistaken. Probably there will be then there will be such a press conference or something. But all in all, I doubt, even though here probability for July is right now at over 90%. So obviously you can see here market participants are right now expecting the Fed, based on the Fed Watch tool, to cut rates by nearly 90% in July. Probably they make they give such a press conference then or something. But I think, to be honest, and especially after inflation data last, and that is something I presented here, or I prepared here in Trading Economics, you can see that the drop, and it's, by the way, also mentioned here it came in just below forecast of 1.9%, raising expectations that the Fed will start cutting interest rates this year. I think this is very, very conservative. In fact, the question is not if they will start doing this year. This is nearly 100% sure, as we've seen. But the question is, will they start next week? And I think when looking at the developments over the last days here, we can definitely say at Tuesday, I had a look here in a German webinar at the Fed Watch tool, and there we had an 85% chance of the Fed not moving at all. So this column here was at 85%. And this nearly doubled now, 30%, so from 15 up to 30, which means nothing more than markets are, especially after inflation data last Wednesday, are becoming more and more speculative about a potential rate cut from the Fed already next week on Wednesday. And with this in mind, and obviously the market having not fully priced in such a potential step, and knowing that these developments here around the Fed affect especially short-term yields, show that there's lots of room, probably in this case on the upside, respectively, lots of room on the downside if you do not look at the inverse yield here, which means then nothing more that there's also plenty of room on the upside for gold to come. And why is that of interest? Well, and there we now come here at this level, but seems respectively here on the upside, this line, and there we have the weekly chart. The region we are about to enter on the upside, 1,360, 1,365. These are the highs from here, 2018, 2017, 2016, and also 2014. So these are yearly highs. This is a region where nearly every market participant is looking at. And if you're currently short gold, you definitely don't want to be short gold anymore if we break above that level, since due to the strength and significance of this region. So now, obviously, the fundamental picture, as already shown, delivers plenty of reasons and a potential also fundamental driver for gold pushing higher, but not only short term but also long term. When looking at the expectations from market participants up to December, for example, expecting 3 rate cuts, then we definitely have to say, especially also with the potential risk of an escalation of the trade war between the US and China, and still there is no signs of a de-escalation, and we definitely have to wait. And I really doubt that there will be any signs of de-escalation coming from the G20 summit at Osaka at the end of this month, for example. So the thing is that there's plenty of fundamental drivers higher, and also recession fears forming at the horizon, which are usually positive for gold push higher. And now the interesting thing is, from a technical perspective, this is a formation we usually call rising wedge. So a rising wedge is a usually bullish confirmation pattern. Nevertheless, I look at it from another or from a different perspective. So how do I look at this? And therefore, probably let me just do it that way. Let's put it that way. So if I look at the technical pattern, it has to fit the overall picture. So from a fundamental perspective, but also it has to make sense. And what do I mean by making sense? Well, this wedge, it comes out of the fact that the market is rising, finding resistance, pushing back, rising again towards this resistance, finding resistance again, pushing back. But this time, the supply coming here in at these highs is obviously not enough to reach those former lows again. So then we start again, find resistance, pull back, find resistance again, smaller pullback, and then the final break. Because here, at this moment, the supply is not capable of overcoming the demand anymore, and then there is a huge break, and all those who obviously went in short against this level have to cover, respectively, have to reduce their existing short positions. And out of this, you get the following picture. You get here the line of resistance on the upside, and there is the rising wedge or rising triangle, however you call this. And then you have a bullish formation in this case. And now the interesting thing is you can use this formation and project targets on the upside and what you can expect, even though it's just a rough projection. But what I did here in this case is I used these highs and I projected this line lower here. And then you just use this, you duplicate this line and you just put it here, and you get out. This is a weekly chart now, right away. By the way, you get out at around 1,700 or ascending triangle. Yes, a rising wedge is respectively ascending triangle. Perfect. Thank you. Thank you very much. Yeah, 1,700 USD is a projected target on the upside. So it's not only the technical side, which is perfectly fitting this current picture, but it's also the fundamental side. Fundamental, technical side, both are playing a very, very interesting or going hand in hand together here. And there's also something else. Probably let's just do something I haven't prepared yet, but I have an idea, even though the numbers are a little outdated. So the update on these numbers will be published tonight. It's COT day, let's call it. It's Commitment of Traders Report. And there's a website. It's barchart.com, and they deliver these data for free in a very nice way. So all in all, the numbers published here from the CFDC are for free. But usually you have to really search a little to find a website which is then making a nice chart of it. And here below futures and Commitment of Traders Report, you can see there, you can see the currencies, financials, indices, and a little higher here below metals, you can also see gold. And what we do now is we have a look at how is the speculative side position. So the green line is the large speculators. These are big CDAs, big hedge funds. And what you can see is, yes, they started to build long positions again after being net short for the first time, I think, since 2001, if I'm not mistaken, 2002. Here it was at the end of last year, but still we are in. Well, it's not far away, but still I think there's plenty of room on the upside. So right now the market is not as long as it's supposed to be when it's entering such a critical zone of resistance from a technical perspective on the upside, which means we should definitely expect some buys stepping up once we break above 1,365, 1,370 USD. You probably can't spot it then right here, because this is updated only on a weekly basis. But here, our advantage of being a retail trader comes into play. We do not have to take care of any regulatory bodies like the CFTC or something like that, but we can just enter the position whenever we want, and we don't need to tell anyone about this. And so for us, this is probably a chance to follow here, strong buying potentially entering the market then, and following just in the shadow of these market participants a significant break on the upside. I mean, still there's a chance of a fake out on the upside. All this, yes, sure. Still, I have to say that I consider gold here to be long on a daily time frame, as long as we trade above 1,266 USD per ounce. So I think this is a really crucial level on the downside, and I think again with the FED next Wednesday, chances are really high that we are at least getting to see a quite significant attack, and probably it's good for some USD per ounce on the upside, only for a few days, even though I think that the break will be quite significant, especially in the current market and environment in which we find ourselves right now. So that said, by the way, there's also something else which is worth noting. I mean, we're talking about gold. Gold is usually negatively correlated to the U.S. dollar. And when looking at gold, we are also looking at a market which is usually very yield sensitive. That means that gold is not paying yields. It's a classic safe haven. You're looking for an investment in gold in times of political instability, in potential recession hitting the market, in times where yields is not what market participants are looking for, but they are looking for safety. And in this context, it's very important to note that there's usually also a negative correlation then between dollar JPY and gold, which means if one is rising, the other should fall, and the other way around. So if we are very bullish for gold, that means naturally that we are bearish for the US dollar, respectively bearish for dollar JPY. And in this context, it's very, very important to note the following. There's also another chart. I've made a topic here. I've retweeted in my Twitter timeline. We have to scroll a little. It's already from yesterday, but I think it's very, very interesting. These two lines they illustrate the developments in the 10-year rate differential between U.S. and Chinese bonds, and in the DXY, which is the short form for a US dollar index future. So DXY, or the US dollar index future, can be found in yellow, while the yield differential between US and Chinese 10-year bonds or bond yields can be found here in pink. I think the chart speaks for itself. So currently we are still stabilizing at an elevated level in the US dollar index future, but I think chances are growing and higher and higher and higher that we are about to close this divergence. And I think it will be the way that the yellow line, the yellow chart or graph, will go down instead of the pink one will reverse. And this is especially true also when looking at the Fed decision next week on Wednesday. Usually you expect a dovish Fed, dovish in her rhetoric, respectively dovish when it comes to rates, and probably a surprising rate cut. You expect it to be bearish for the US dollar, which could definitely push the US dollar significantly lower. Why is, by the way, the US dollar stabilizing so far? I think one of the main reasons is because the euro has such a huge weight in the US dollar index future. So the US dollar index future consists of several currencies against which the US dollar is calculated. And within this basket, the euro has a weight of 58%. So if you have such a huge weight in this basket, and the US dollar has the euro has really trouble to gain momentum. The only reason for this push higher over the last days, especially after the ECB, is not necessarily the rate decision from the ECB last week on Thursday, where the ECB delivered details on their TLTRO program, which starts from September onwards, and where they mentioned that the yields there, or the price, the yields, whatever you say, they give out this liquidity will be slightly above zero. So some market participants said it's necessary to come out really dovish here to put a negative yield here on this. So if you, let's put it that way, if you ask for, let's say, 100 million, you only have to pay back, let's say, if it's minus 0.2%, you only have to pay back 99.8 million. So, and that would have been a sign that the ECB is really willing to somehow weaken the euro. This did not happen. Some interpreted this as potentially bullish for the euro, since it was hawkish hawkisher than usually or initially expected. I have to say I don't really think that this is true. I think one of the main reasons here for the euro going for a try at least to reconquer 113 was more that the US dollar was just weak. I think that's the main reason here, and so with this in mind, this is a clear sign of why currently U.S. dollar index future is not dropping sharply lower, even though here we should keep in mind the Fed rate decision next week. If the Fed comes out very dovish, if they cut surprisingly rates, I think then U.S. dollar will really collapse, while the euro has a significant chance to push back above 113 and go for a stint up to 114.50, 115. Even though I have to say I'm not really a big fan of buying such a move higher, since the euro is not really strong compared to the US dollar. I definitely favor short engagements in dollar JPY, respectively long engagements then in this case in gold. I think this is definitely markets which should be expected way stronger against the US dollar, also from a relative perspective than the euro. And in fact, that's it. That's in fact it. So probably some of you might be interested in some developments around pound sterling against the US dollar. So currently we find ourselves in a seasonal pattern or a seasonal window, which is usually positive for pound sterling. But so far, pound sterling has trouble to gain momentum. This is probably especially true due to the uncertainty around the Brexit, still ongoing uncertainty. No one really knows who will be the successor of Prime Minister May. So far, it looks as if it will be Boris Johnson. Still, we don't really know in which direction we have to expect him when it comes to the Brexit negotiation. And that's not only uncertainty at our end, but it's also uncertainty you can clearly spot in the interbank banking market. There's this tweet also from yesterday, very interesting. Sterling trading volumes have fallen sharply since March after Britain delayed its exit from the European Union. An average daily trading volume of the pound shrank 9.1% in May versus a year earlier. That means nothing more than big players are right now stepping back from pound sterling because there are still, there's no real opinion at their end or information about where pound sterling, respectively Great Britain in general, is headed in regards to the Brexit. No one really has an opinion here, and if you can't calculate any risks, then you usually step back and wait till the dust settles, and then you go for a position. That's usually the reason for this drop in volume. Yeah, so that's it. That's it from my end. I have to say the following. I just see that there's a question now on the Dow Jones. The following happened, and this is now one market which I miss here. Why do I say that? Well, yesterday, for some reason, my layout was deleted and I had to rebuild it. And I was sure that I have every chart which I had before here. I have every chart prepared. Now I see I forgot to include Dow Jones and I forgot to include the S&P 500. So these are definitely two markets I have to open here, but nevertheless, and that's the reason why I can't dig into too many details when it comes to the Dow Jones, respectively, the S&P now, because it takes too much time to open the chart now. But what I can tell you is, based on the seasonality I mentioned at the beginning, in the DAX, the bearish window which opens, I can say the same is true for the S&P and the same is true also for the Nasdaq, but I'm not really sure whether it's also true for the Dow Jones. So just let me have a look here at my other screen. Okay, no, I don't have it for the Dow Jones. I only have it the bearish window, which opens next week from Monday till next week Monday, then in the E-mini S&P, and the same is true also for the Nasdaq. Yes, which starts on the 25th then already. So if you want, it's a rollover. So yeah, we're bearish opening. We are in a bearish seasonal window next week, and then the week after. from the beginning of the last week of June here into the first 2-3 weeks of July, there's a bearish window in which the Nasdaq enters then. Yeah, so I hope this is fine. Nevertheless, next week on Friday we have the next weekly market outlook webinar here. I'll definitely prepare the Dow Jones chart again and then the S&P chart, just to let you know. And yeah, so that's it from my end then. I wish you all the best. Happy trading. Have a nice weekend. Enjoy yourself. I just hope that you enjoyed this this webinar. If you have any questions, or if you want to have a look here at the recording, feel free to also have a look then tomorrow. It will be uploaded tomorrow in the YouTube channel from Admiral Markets. There will be the recording. On top of that, I highly recommend having a look here at the analytics section at admiralmarkets.com, and then analytics, especially the traders blog, but also the technical analysis section. You will find plenty of input there on different markets, and that's it. So all the best. Happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again next week on Friday. I look forward to it. See you, and bye-bye.